Okay, so hi, my name is François. Hope you're doing very well. I'm the main trainer and founder of GSTA, which is Global Street Trader Academie. So we will see today as a little bit notion of like mathematics applied to the Forex markets, and I will reveal you why there is certain Forex pair that it's advantage to for trading, and also you will see the case of the franc CFA. Franc CFA is like the colonial currency used by the most of West African, including my country as well as Ivory Coast, because I'm origin from Ivory Coast. So in this video we will see that, and then you can also apply or use a new approach on the financial markets. So it's your first time to discover me. I'm the main trainer and founder of GSTA. Then you can find us through different social media as well, as Twitter, Facebook, YouTube, and also I have the trading view where we posted a couple of trading ideas and also articles, so you can take a look there at my profile, which is Frank Belfort. Also, we starting a training courses at the GSTA for the winter session. We're starting to the since the 18th February. We ended to the 4th June. So if you're interested, you can take a look at the website. Right, we offered a couple of services, and also we are in current session of training courses, right? So here is it, the globalstreettrader.com. so www.globalstreettrader.com. you can take a look there quickly. Okay, so in this video again we will discuss about the notion of mathematics applied to the Forex markets. So I make this video especially for African Forex traders, because I know that they really love to trade Forex markets, and some of them ask me a question about to understand really well the Forex market. So I will just give you this free content, and then I believe that he will help you for to have a new approach on the financial market, including also others content that I already gave to you guys. Okay, so basically Forex markets is the most difficult market to trade. Why? Because this market is pure mathematical. It's a pure mathematical, because you have to know and to understand that Forex market is not a stock market. When you say stock, so you know that we have a stock versus flow. So I will change the pen, because the black pen is it's done. So okay, so we have stock versus flow, right? Stock versus flow. So stock is something that you can, sorry about that, you can like decrease, you can increase, you can stay neutral. This is a stock, right? But the flow, it's like a movement, right? As the flow, we have a movement of convergence, of divergence. It's a movement, essentially, the flow. So the stock, which is equity, bond, commodity, and others, products, ETF, those stuff. But the flow, it's CDS, CFD, Forex, and those kind of things. Okay. So stock versus flow. And Forex market is a flow market. So flow is we don't have a certain quantity of, certain quantity of the transaction traded by a different party. We know that we do have a third party. We don't actually know which one who is trading like biggest amount, because Forex trading is not like centralized as the traditional market at equity or bond. But we certainly know that to measure the flow of the market on Forex market, we need to see the performance of different currency, right? So that's why the first thing that you have to do if you want to trade, you want to be a Forex traders, beyond the fact that you need to know the macroeconomic data, the macro, doing interpretation or technical analysis, you need to know each week the flow of the market. So which one, or not which one, but who is buying or who is making this certain currency strong and others make a certain currency weak, right? So you need to visualize like at a certain website that I show to people who take my training courses, who is like the platform that we can go to see which one performance, and also the net flow of the institutional traders, or those kind of things, to that does give you like information about which one currency that you have to prioritize. And also we will see also the calculus on a different assets or different or major major Forex pair that we use to trade, and make sure that we'll be in the right position, like most of time, because there's no 100% guarantee that you will be certainly all the time right about this market. Okay, so stock versus flow. And we have also the fact that as you see the performance, as you see how the which one currency that we have to cumulate it, you need to know that any type of market or any type of currency pair evolved to the baskets, currency basket, right? For example, we do have like, this is our basket here, and we do have euro, right? We have yen, okay? We have here CAD, we have here US dollar, we have here a Swedish krona, we have here let's say pesos, Mexican pesos, right? Mexican pesos, and so on and so forth, right? Right. So this is a basket of currency that's a couple of central banks own that to their account, and they play with that because each currency need to be floatable, in function of others' currency. And this is also one of reason that the CFA or the FCFA is not great for African country, because it's completely fixed in terms of like the parity of the euro. We will see that after the mathematical demonstration on the CFA. Okay. So based on that, the currency markets use a formula. We call that in mathematical, we call that the GAC, right? GAC. We call that GAC, right? GAC formulation, which is geometrically average calculation, right? Or we call that, or can call also the also WAG, which is weighting average geometrically calculation. Okay, so it's exactly the same as the formulas or different currency that we use to do on the different pair or different Forex pair that we need to know. So basically, when you choose another, like a different pair you would like to trade as a fundamental or as a technical analysis, the question is not about to know like the pattern, like ascending wedge or this stuff, or see the macroeconomic data. For sure, it's the information which is help you to understand really the evolution of the markets. But also what is very important to know is to see which one the performance, what is the performance of this currency, or what is the the flow between this currency according to or in function to its currency basket in terms of others, right? And we do have the major, we do have three major currency pair in the world. We have the Japanese pair, so the yen. We do have the US dollar, and we have the euro, right? Today we will see the example of the US dollar, right? The US dollar, which is already studied by is already studied by and doing some like empirical study by the ICE, which is the Intercontinental Exchange, which is is a market, central market place where they doing trading for future option. They based on Atlanta. It's a kind of the Chicago. So it's a marketplace where we centralize like a product, and as well as the same thing as NYMEX, NYMEX, Euronext, those kind of structure. Okay, they do this already, this study, and that's what you will see here, the composition. So basically the formulas of the geometric average weighting. Okay, so the geometric average weighting for the for like the process or the calculation that they use to create a currency. So everybody can create a currency, because we need to just use a basket of currency to just counter weighting all the fluctuation for the different pair, right? Then it could give you kind of sectorialization, or also a big a big constant that you can you can put that to the on the certain parity. It could be on the commodity market, it could be on the bond, depends on like what in your country is very strong. So the we can call that the constant little a, right? I will write that. So little a, right, as you see here, little a is the product of, so I going to from 1 to n for x I powered wi. So x is the data of the currency, and or we can also say the amount of the currency, like the amount, and this is the w. It's the weight, right? The percentage of weight of the currency to the economy, right? So on 1 over the sum until from 1 to n wi, right? So don't be impressed by this calculus. It's not complicated. It's a very simplistic calculation. If you do algebra or economy, you pretty much know how to resolve that. And it's not the case for this video. It's just to see the demonstration where the forex pair come from, right? So I don't want to be doing like step by step like all this demonstration, but it's just to see the the logic behind that. Okay, so here is the formulas. So that being said, that if x and right w belong to the real number, right? So we need to make sure that x with I and w with I belong this range of number, so from 1 to n, where x for the data is x1, x2, blah blah blah, xn. Also w equal w1, sorry, w2, blah blah blah, wn, right? This is the definition set that we make sure that it follow this it follows. So all the currency must follow this definition sets for mathematical. Then we can prove that we can find this constant here that we will doing after establishing these formulas. Okay, so here is the formulas for the geometrically average of geometrically average for the weighting, right? So this is the main fact that we need to see if you're doing like currency trading for the forex. We have a certain data of the or the certain amount of the currency in the central banks. There's like a forex guy is behind like a sheet of a composition of different currency for different currency, that so a basket of the currency, and then each day he's playing with the quantity of the constant, because it's a fluctuable, right? So it can increase the value of the dollar versus decrease the value of the yuan, increase the value of the yen, and decrease value of the Swiss krona, or Swedish krona, or the Swiss franc, vice versa, right? Okay, so it's playing that, and that's why we see sometimes that we could have erratic movement on the forex pair, and we don't know what's happened, right? But we just want to see, we just want to follow like the movement of the forex, this forex data, which is have like massive rally or massive collapse, right? So as we define this these formulas for the geometrical average weighting, we want to simplify that by putting the exponential, right, as the sum, right, which is come from 1 to n wi ln xi, right, or over the sum again of the I from equal from 1 at n wi here. So I will erase all this precision here, not just mixed up. So this is the simplification that we do have with these formulas, because I just move the step. I don't want like doing like the demonstration. It's not the goal of this video. It's just like the models that central banks use to create money and make money flowing right around the others currency, right? So we're going to that. So if that here is very easy, so we do have just to simplificate those things. So that being said, we do have exponential and then the xi, right? I'm just writing this. So we have exponential ln xi, right? So we have that. And when we have that, we can rewrite that to simply have a simplification here, which is xi ln of the exponential, or we can put ln e or ln exponential. It doesn't matter, okay? Which is give xi, because ln of exponential is 1, right? This is the simplistic resolution of ln, the ln of exponential. Okay, so we found the xi. So xi is curiously is the constant for the constant to to create the currency, the basket currency that we found here, which is himself weighting about all the different currency as for different pairs, which is composed the basket of currency, right? So it's a pure mathematical, okay? All right. So now, according the IC, as I said, IC features, which is the intercontinental exchange, they said, well, USD, so USD, the currency USD, with his constant, right, it's calculating by this formula. So big XI, we know where the XI come from. We already doing the demonstration, so now we do have to implement that to the currency, the basket of currency, which is euro, weighting at, so we have WI here times the GPY, so the yen, right? WY times GBP, right? Times Swedish krona. So Swedish krona, so the currency of Sweden, times also Swiss franc, right? Times the loonie, the card. Okay? So basically, I can go in here. Okay, here. All right. So basically, that being said, that to create a currency, you need to own a certain as couple of others currency, which in the country of this currency, there have been some integration. There have to be no corruption there. Stabilization of the monetary policy. No tension, social tension. A couple of factors which is guarantee the solidity of this currency. You have to implement that to the currency of the basket of currency. Then you can play with the flow of the flow of this currency to make your currency be attractive, right? So that's why when we do have like some a risk of on the markets, most of traders prefer to to get some dollar as a safe asset or safe currency, because it's weighting with euro, yen, GBP, Swedish krona, Canadian dollar, and Swiss franc. So 6 currency, which is the country was very strong in this currency, right? And they play with the flow of to make great the value of the US dollar. And when we do have a risk on the market, where people have an appetite for the risk, they don't need to to keep US dollar, so they just get rid of the US dollar, and they're going to increase the value on yen, euro, GBP, and other stuff. Depends on the market that they trade. So this is the fundamental idea that you need to understand when you're doing Forex trading. Okay? So now it's giving to the XY, which is the IC, which is the intercontinental exchange features, based on the I think close to the 30,000 observation that they doing with empirical and econometrical a model. They're estimating the XI, so the constant for all the basket currency. They estimate that to the 15, right? So this is the constant of this equation. With euro dollar, which composed by 0.58, this is the weighting of euro in the USD. It's 0.58, 0.58, which is times that by the yen, so GBP, so the yen, right, GBPY, 0.14, right, 0.14, times by the GBP, which is multiplied by times 0.12, right? This is the weighting of the GBPY, so the yen, and GBP, the pound, the sterling, which is 12%. The yen is 14%, and the euro is 58%. Okay, times by the Swedish krona, which is 420%, times the Swiss franc, which is 3.6%, and the CAD, the loonie, Canadian dollar, which is 91%. So I will write that to the top, then you can see, because I know the camera doesn't show you correctly here. That's why I'm watching continuously the camera. So I just rewrite all I already writing. So 15, which is the constant for the constant of the basket of currency. They all multiplied all the content for currency, which is, so the euro is 58%, times the yen, which is 14%, the pound, the sterling, which is 12%, the Swedish krona, which is 420%, okay, Swiss franc as 3.6%. So this is the weighting of the weighting of the currency in the US dollar, okay? And the Canadian dollar has 9.1%, right? So the little secret that if you want to be successful on financial market for Forex trading, you can, it's silly to say that, but you can choose one of these trading pair for trading. Then you can actually be pretty much sure that you will have like a strong momentum when one of these different pair are strong or weak, right? Because we know the weighting on the Canadian dollar, which is 9.1%, to the total of the currency, the basket of currency in the US dollar index, right? And the euro is 58%. So that's why when the euro going down, the dollar going up, it's pure mathematical because of the weighting, right? So now you can just be focused and make sure that when you see the charts of the US dollar index, you can see that the euro dollar, if euro dollar are starting to getting low, you pretty much sure at 80% that the dollar will be like the opposite. That's why, because they have like a strong weighting, which is kind of interpreted as the correlation, inverted correlated, okay? Right. So here is the composition of the currency, and you know why one of pair are going up and another going down. So now we already write this model that we previously used to write as the 1 equal 1 to n xi wi, right? Which is powered as the sum from I to 1 until n wi for each currency on the basket has been weighting by a certain quantity of the currency, by which is managed by they own different central banks, right? This is actually the model that we use, okay? So that being said, if you rewrite that, so that being said that for USD dollar, which is the XI, equal the product, again, from I until 1, and for euro, because it's a euro as being like the highest weighting in terms of, the link between those both currency, we can consider as the euro is the inverse of the US dollar index, right? So that's why we put that here, 1 until its own ponderation. So I here for each currency, which is, depends of the euro dollar, with all x, which is the constant or the data, belong to the real number is starting from 1 to n, and also wi also it's belong to the number, real number, and it's going to the n, right? This is a mathematical propriety definition, right? So if we rewrite this equation, we find that we found the euro dollar on the USD. So euro dollar that we use for trading equal the XY WI, right? I will write that, sorry. All right, so this is the mathematical equation that we found from this one, because if we're doing manipulation, because here it's the inverse of the WY, we just have to put the quantity of the currency to transform that to the fraction here. So we're doing the inverse. So that's why we turn this constant to the WY and the XI here, which is on base for the US dollar index. Okay, so it's a pure mathematical algebra, and this is the the form of the currency per fraction that we found, and people actually trade the US dollar versus yen, euro dollar versus dollar, because mathematical is the proof to find that. And that's why if the constant of the euro dollar versus the euro for the dollar is 58%, as we defined according to the the ICE, intercontinental exchange. And then we do also have the weighting here, which is 58%, and here is the XI that we found before, like the previous manipulation algebraic. We do have the 15, right? 50 percent that we found. So that's why curiously, when the euro going up, the dollar going down, and vice versa. And it's this form for different currency pair for applied to the different, compared to the different pair versus each other them. And then that's why also we need to prioritize like the certain currency, which we know pretty much, we're pretty much sure that the flow will be in our side when we see like the different in terms of performance. That's why we call the carry trade that I teach through the academy, right, for the Forex traders. This is just for like an introduction for the Forex market. Okay, so here you found your euro dollar pair. Okay. Okay, so that being said, that basically is not difficult to create a money. So this time you actually pretty much heard about, like, lots of people talk about like especially African, which is living to the West Africa, where my country is part of that. So Benin, Togo, Burkina Faso, Ivory Coast, where I'm from. They talk about the cancellation of the franc CFA, right? Franc CFA, right? So franc CFA, for any people we don't know what it is a currency for used by the French colony in Africa, where my country come from. And also the deal of that, the mechanism of this pair is when we sell our product in our currency, they take from the whole amount that we do already sell a couple product, 15%, 55%. They use that to giving us the convertibility in terms of the parity fix. Then we can use our currency between all around Africa. But the problem is this currency is not recognized by others country. Instead, the exchange flowing, right? And we cannot also use this currency between others, like different African countries. So that's why it's a very polemic currency, and most of Africa now think about to cancel definitively this currency. So you can feel that we have been scammed to use this currency. And as a young African, personally, I'm strongly disagree with this kind of system, because as we see with the calculus of the principle of the geometrically average weighting, because this is the only way to create a money, because we need to do a currency, a basket of currency. Franc CFA has no basket of currency, right? With franc CFA, we use just these formulas. We have like the X bar, which is the fixed parity of convertibility of the franc CFA, and also the W. That's so the weight, it's also fixed, the bar. We don't have like any baskets of currency with others country. Then we can play with that. We just depends of certain certain product that we sell that in our currency, and we have to make sure that the France, which is the only country who can like give us the allowing for trade this pair, before that in euro dollar, right? In euro, not the euro dollar, in euro, right? That being said, the euro will give us the guarantee to make sure that we don't have to worry about like the fluctuability of the currency. That we fix that to the one a certain number of the the exchange day to day. And after that, we do have to give them our product for the 55%, which is stock, in return to the to have like the convertibility in this parity, right? So it's absolutely it's not a good things, right? But the problem is not the issue is not just to create a money. I already show how to create a money. Any monetarist and any economist, central banker could create money in 2 minutes. It's very easy to do that. But the problem is we do have to make sure in certain factor as the integration for the country. So any country in Africa, we have to be agree to to support each them for the flowing of the product convergency. So it's a kind of policy of convergence for the product. For example, Cameroon, produce mango, but in Ivory Coast we produce also mango. But we have to decide that it's only Cameroon have the exclusivity to sell mango, right? We have a cocoa, and Ghana also have a cocoa, and we can decide that Ivory Coast have the only exclusivity to sell cocoa, right? And if we're doing that in different country, then we can make sure that we can use the mechanism of the convertibility of the currency. That is first. The second thing is also African country didn't ripen country to create the money, because there's a lot of corruption there. Most of African leader or presidents, they cannot guarantee the fact that they will very be strict and credible to guarantee a certain quantity flowing of the money or the currency in the economy. We already saw the case of Zimbabwe with Robert Mugabe, that he doing hyperinflation because he's starting just to print money day to day, week to week, because you want to be rich, right, or billionaire. So this is the case that it's difficult to just create money. I'm just talking about like like a rational point of view, based on the currency, not just emotional point of view, because most of African, what they approaching this question, they just emotional, because it hurt us. It hurt us, it hurt our economy, it hurt us, our development. So that's why it's very difficult to grow up with this system of parity of the currency, right? So there's a lot of principle that African must to be together, united, before to create a money. It's not about just the fact that could we create a money, yes or not. And some country have scary about the fact that if we create money, we will doing bankrupt. It's not about that. It's just to make sure that we confirm this principle of economy, so which is the integration, regional integration, the policy of the convergence in terms of the products, so the Ricardo theory, right? Competitivity product between our area economic zone. Also, we do make sure that the leader do not like order the central banker for increase the quantity of the money when he wants, right? He has to be very strict and doing like the transparency. And also we do there's lots of things that we have to think about before talking about the currency, right? So this is the model. Actually, I close this little parenthesis, this little bracket. So that's why this is the model actually that the franc CFA is, like the euro, X bar, franc CFA, little W bar 2. So we don't have any currency. So if we create like the basket of currency, and we don't want to, because some economists said it's easy to impose the country to buy our product in our currency that we will create. But what if they do not, right? What if they don't buy our product that we sell them in our currency to make a flow of the economy? We could have, unfortunately, a deflation, right? Because the people we will see like that money could be extremely rare, and we cannot have like the credit between like the enterprise. They cannot allow credit to make like the economy and support the growth in the production. So that's why they will keep the money, as the Japan suffered that for 2 decades for the deflation. Or also we can have like irresponsible leader who can ask central bankers to print money, then they would like to use that to be billionaire, unfortunately, as Robert Mugabe does, right? And that's why it's very important to treat this question with rationally and not just emotionally, okay? But I want that as an African, we need to have our money, and to create the money is not like I'm a junior economist, I'm not monetarist, and I know the principle how to create the money. So any African economist could create the money one day, but are we ready for that, right? It's a question that we have to think about instead to doing like a political things, right? It's very important. Okay, so basically it's that. I finished to expose what I would like to do. So thank you so much for watching this video for African traders. I really enjoyed it. It was very nice to see this video, to record this video for you. So if you have a question, feel free to ask me, because I know that lots of you doing Forex markets. So you can ask me a question on if you understanding this model that I exposed, because it's that we use to make money on the financial market. All students on my course, I know actually how to trade properly Forex markets. I give you just the introduction, the notion of introduction of Forex market. So like it, share it for sure, leave a comment, put your point of view. If you disagree, if you agree, let me know about that. And also take a look on GSTA, www.globalstreettrader.com, and we'll see you around for the next video. Thank you so much for watching this video. See you. Bye-bye.